You want to get rich quick? Well, duh, who doesn't? But this isn't that. This just gets you rich by barely doing anything. Welcome to Life Invest Insights. Today we're taking a voyage back to the genesis of disciplined investment, to honor a figure whose foresight and teachings have sculpted the craft of value investing. This visionary, often revered as the Dean of Wall Street, penned doctrines that have stood as guiding beacons for nearly a century. His name is synonymous with investment wisdom, yet we'll let his principles introduce him before we speak his name. Confronting the tumultuous waves of the Great Depression, this maestro of the market composed the foundational texts of value investing, manuals that have withstood the test of time. As an educator, his classroom extended beyond the university halls, influencing the global financial landscape. The anticipation builds as we prepare to unveil this pioneer, whose legacy is etched into the fabric of finance. At the heart of his teachings lies a simple yet revolutionary concept, the margin of safety, a principle that has redefined investment strategies across generations. It's a doctrine that champions the prudent over the perilous, ensuring a cushion between investment price and intrinsic value. But who was this architect of financial prudence? How did his margin of safety principle pivot the paradigm of investing? In this episode, we're not just retracing Benjamin Graham's illustrious career, we're absorbing the essence of his life's work. We will delve into his timeless strategies, the life lessons he imparted to his students, and the indelible impact he made on the philosophy of investing. Graham's legacy lives on, not merely in the pages of security analysis or The Intelligent Investor, but in the ethos of every prudent investment made today. His teachings resonate with a clarity that transcends the fluctuating patterns of the stock market, offering a shield against its inherent uncertainties. Join us as we explore the depth of Graham's insights, his unwavering commitment to the margin of safety, and how his wisdom can be applied in the current tapestry of global finance. It's more than a history lesson, it's a journey into the very core of intelligent investing. What's it? This isn't financial advice, and you shouldn't make direct choices about your financials for stuff you heard here directly. In the realm of investing, the term margin of safety epitomizes the philosophy of safeguarding one's investment against the unpredictability of the markets. Benjamin Graham, the astute mind behind this concept, advocated for a method of investing that doesn't just aim for profits but emphatically seeks to minimize the risk of loss. The margin of safety is the difference between the intrinsic value of a security and its market price. Graham insisted that the intrinsic value should be determined through rigorous financial analysis, examining assets, earnings, dividends, and the financial health of a company. Only when a stock is purchased at a significant discount to its intrinsic value does an investor truly have a margin of safety. This buffer protects the investor from errors in judgment or unforeseen market downturns. Understanding this concept requires a deep dive into its three core components. An intrinsic value assessment, how to meticulously analyze a company's fundamentals to estimate its true worth. 2. Market price fluctuation, understanding the volatile nature of market prices and why they diverge from intrinsic value. 3. Risk management, strategies for employing the margin of safety to mitigate investment risks. In this detailed discussion, we'll explore each of these components using real-world examples to illustrate how they interact and how an investor can apply this principle in a practical context. We'll see how the margin of safety isn't just a defensive measure, it's a proactive stance, a calculated move in the chess game of investing. Let's start with the first one. Intrinsic value assessment. Consider a company like Apple. An investor using Graham's approach would look beyond the stock price and examine Apple's financials, including cash flow, debt, revenue, and earnings. They would assess its brand strength, customer loyalty, product pipeline, and management quality. The intrinsic value is derived from these factors, giving a more comprehensive picture of Apple's worth than the stock price alone. Market price fluctuation. Real-world example. Tesla's stock price has experienced significant volatility. It's influenced by various factors, including Elon Musk's public statements, advancements in electric vehicle technology, and changes in government policy regarding green energy. Graham would suggest that these fluctuations might not reflect Tesla's intrinsic value, which should be based on deeper financial analysis. Risk management. Real-world example. When the housing market crashed in 2008, the stocks of many financial institutions were trading well below their intrinsic values due to panic selling. An investor following Graham's principles might have seen this as an opportunity to purchase stocks like JP Chase at a discount, providing a margin of safety as the market eventually corrected itself. Understanding and applying these components can help investors make more secure investment choices, aiming to preserve capital and achieve satisfactory returns. Graham's investment principles go beyond simple rules. They encompass a comprehensive understanding of the market's behavior, a thorough analysis of financial statements, and, importantly, a disciplined approach to investor psychology. He introduced the allegory of Mr. Market to personify the mood swings of the market, sometimes euphoric, sometimes despondent. Graham taught that an intelligent investor should not fall prey to Mr. Market's moods, but rather capitalize on them. We will dissect these principles, look at how Graham evaluated stocks, and how he recommended investors to conduct themselves amidst market volatility. Benjamin Graham's investing acumen is exemplified in several key investments. Graham's investment in Geico was visionary. 1. He recognized the company's unique business model and its potential to disrupt the insurance industry. 1. By securing a large stake when it was still a young and undervalued company, he was able to capitalize on its growth. 1. His initial investment cost him around $712,000. It ballooned to an estimated value of $400 million by the time of his death, showcasing the power of identifying growth potential and holding long-term. 2. Northern Pipeline Company. Graham's analysis of Northern Pipeline's financial statements revealed a hidden gem. The company held significant railroad bond investments that were not reflected in the stock price. 2. His advocacy for shareholder rights and the distribution of these assets was revolutionary at the time and led to a distribution of approximately $70 per share, whereas he had bought the stock at around $65, highlighting the significant returns that can be achieved through diligent analysis and active engagement. 3. The Great Depression. During this period, Graham's strategy to invest in companies trading below their net working capital was counterintuitive given the pervasive economic fear. He focused on stocks that were undervalued even after accounting for all liabilities, which meant they were essentially worth more dead than alive. 3. This approach provided a substantial safety net, and as the economy recovered, these investments reaped impressive rewards, affirming that market panics can create opportunities for those with the insight to see past the prevailing pessimism. Each of these cases demonstrates Graham's extraordinary ability to see past market noise and focus on fundamental value, a testament to the enduring relevance of his margin of safety principle. Benjamin Graham's principles of value investing are not only still relevant today, but perhaps even more essential in our complex financial landscape. His core tenet, investing with a margin of safety, resonates strongly in today's volatile markets, where rapid information flow and complex financial products can create significant price swings and uncertainty. Graham's strategy of thorough financial analysis to determine a company's intrinsic value provides a bulwark against the short-term thinking that often prevails in today's investment world. By focusing on long-term fundamentals rather than temporary market movements, investors can make more informed decisions that are less susceptible to the whims of market sentiment. Moreover, Graham's advice to seek out undervalued stocks, those trading below their intrinsic value, is a countermeasure against the speculative excesses that can inflate asset bubbles. In an era characterized by high-frequency trading and speculative investment in unproven technology startups, Graham's principles advocate for a more conservative approach that emphasizes financial stability and sustainable growth. His emphasis on investor psychology, understanding the propensity for irrationality in the markets, is also highly applicable in the current era. The rise of social media and its impact on investment decisions has often led to herd behavior that Graham's teachings warn against. Applying Graham's principles today might involve looking for companies with strong balance sheets, low debt, and consistent earnings that are trading at a discount relative to their peers. It also means being cautious of overvalued sectors that are popular with investors but may not have the fundamentals to back up their lofty valuations. In practice, Graham's approach would favor industries with tangible assets and proven business models over those that are popular or in a bubble phase. It would also advocate for a diversified portfolio to mitigate risk and ensure that a safety net is in place should any single investment falter. In summary, Graham's principles serve as a compass for navigating the often turbulent waters of modern investing, providing a framework for making prudent, disciplined investment decisions that can withstand the test of time and market cycles. Benjamin Graham's legacy is a testament to the enduring power of sound investment principles. His margin of safety is not just a technique, it's a philosophy that champions prudence, patience, and persistence. As we conclude this insightful journey into Graham's wisdom, we invite you to embrace these timeless principles in your own investment endeavors. Become a champion of your financial future by applying Graham's methods to your portfolio. And remember, the first step towards investing in your success is simple and costs nothing. Hit the like and subscribe button to join us for more empowering financial insights on Life Invest Insights.